Welcome to CNBC's Crypto World. I'm Liz Napolitano, a markets reporter at CNBC, and today I'm here with Matt Hougan from Bitwise and Sebastian Bea from ReserveOne, both CIO at their respective companies. Now, Matt, Sebastian, today we're here to discuss the Bitcoin 4-year cycle. So this has kind of existed as a framework for investors to kind of gauge where Bitcoin is going in terms of price, and it's been used for more than a decade. But nowadays, as more investors are flocking into BTC, particularly institutional investors, there's been some talk that this 4-year cycle is no longer applicable to Bitcoin. I want to get at a high level what you guys are thinking. Is this 4-year cycle still applicable to the token? Is it kind of going the way of the dodo bird? What do you guys think here?
I'll take a stab. I do think it's less important now than it was in the past. I think the 4-year cycle is being replaced by a 10-year grind, by which I mean there are big new forces in the world. They started coming in with the launch of the ETF in January of 2024. They were accelerated by regulatory progress in January of this year. We have the growth of stablecoins and tokenization. I think those forces are bigger and stronger than the forces that historically caused the 4-year cycle. So specifically, I expect the market to be up next year. And so therefore, from that perspective, I think the 4-year cycle is quote unquote dead. I still think it matters because it's in people's minds. I think it's one of the reasons prices have been suppressed this year. But do I think we're in a 4-year cycle? No. I think we're in a 10-year grind upward of strong returns, not spectacular returns, strong returns, lower volatility, some up and down. But I think next year will be up. And so I guess from that perspective, I think the 4-year cycle is quote unquote dead.
Got it. Sebastian?
Well, in markets, we are unfortunately still today, for the most part, having humans trade assets, right? And humans are predictably irrational, right? Now, we can all sit here and argue why the 4-year cycle doesn't make any sense anymore. It's a commodity, and the 4-year cycle was built around the idea that miners were going to be selling less Bitcoin, and therefore there'd be less supply, and with more demand, you'd have higher prices. And that's largely played out. So we can argue reasonably that it shouldn't really make sense. But then again, a lot of times humans don't make sense, at least for periods of time, right? And where are we today? So all-time highs were 125,000. That was in early October. We are, bordering on 86, 87,000 today, down 30% relatively quickly, right? Pretty painful. So I think it's hard to say for sure that the 4-year cycle is dead. Now, I think we should also look at the fact that this cycle hasn't been that great so far, right? So if we are concerned that the cycle pattern could repeat at least a little bit, we have to ask ourselves, what does that actually mean, right? Because if the increases in Bitcoin were on the order of 20x or 3x, and this time we got about 2x from prior peak to this peak, well, it hasn't been that great, right? So if it indeed has not been that great of a return, and we're about to head through, let's say a chop period, we might already be in the middle of it, right? There could be a case that the 4-year cycle still matters, but the severity of the upside and the downside is really different. And then I think also, we're also seeing some decoupling, I think, from Bitcoin and crypto, right? I think one of the biggest things that's happened, even in the preparation for coming here, has been the announcement from the DTC to bring $99 trillion of assets on chain, right? Well, we certainly weren't talking about that in 2021 or in 2017. Now it's actually going to become a reality, or at least the start of it, in the middle of 2026. That's the difference, right? And it could create its own cycle. Maybe it's 4 years or maybe it's 10 years.
Now, that's a lot to think about, but I kind of want to go to the theme of distribution, right? So distribution has changed quite a bit for Bitcoin in the past couple of years. We've got, according to River, a Bitcoin platform, still about 2/3 of the holders of the token are these smaller retail investors. I'm just kind of wondering what you make of that kind of proportion of this more than 2/3 of Bitcoin holders being these retail investors versus this growing number of institutional investors. Do you see that balance continuing to change? How does that inform Bitcoin's price trajectory? And then also maybe a little bit, I want to get your takes on how does an institution trading during the market hours from the opening bell to the closing bell, inform Bitcoin's price action versus like somebody who's trading 24/7 on a crypto native exchange?
Do you want to take a first shot?
Sure. Well, in the case of institutions, just from my experience at BlackRock and over at Coinbase Asset Management, we know that institutions trade substantially differently than retail, right? Retail investors historically are very much momentum based. If it's up, they're buying. If it's down, they're selling, right? Institutions in their plan documents actually have the opposite built in. If it's down and it's in the plan, they actually have to buy to reset to their what they call their strategic asset allocation. And so I think that feature has already started to play into the decrease in the volatility of Bitcoin thus far, right? We're starting to see some evidence that that's the case. If Matt's right, that we're in the middle of or the beginning of a 10-year grind, we should start to see more and more of that over time as institutions add Bitcoin to their asset allocation. And when it goes out of bounds, whether it's too high or too low, they either become sellers or buyers. But that is a stabilizing force for Bitcoin in creating lower volatility.
Yeah, I absolutely agree with that. And we are seeing lower volatility, right? Bitcoin is now less volatile than NVIDIA for the past year, which is a remarkable development. I do think this distribution from retail to institutional is happening, right? Harvard is buying and retail is selling. It actually plays into that idea of predictable irrationality or whatever the exact term Sebastian used, which I love. I do think part of the reason we're down this year is you have fast-moving retail crowd that is rotating out in anticipation of that 4-year cycle. And counterbalancing that, the reason we're down 30% and not 60% is you have this persistent, slow-moving institutional buying that's keeping the market up. I think that's probably going to be a common pattern for the next few years as this distribution happens. Maybe like a staircase up and then an elevator down is an experience that we could have in crypto because you have these two people who move on very different time frames. I'll just add one more fun fact from Bitwise's perspective. I think the institution is just sort of hitting its stride. I don't think crypto is used to how slow those institutions moved. As two examples, we just now had the big four wirehouses, Morgan, Merrill, Wells, and UBS, approve Bitcoin products, even though the ETFs launched in January. So we're just opening the doors. The other experience from Bitwise's perspective, our average institutional client allocates after 8 meetings. If they do meetings on a quarterly basis, and they started when ETFs launched, they're just getting to their 8th meeting now. So I do think you have this slow-moving force and then this fast-moving retail trade, and I think that explains a lot of what's going on in the market.
Now, as we're speaking about these drivers that are influencing Bitcoin's price action, I wanted to touch upon President Trump, the administration, and how the current administration and regulatory clarity that's coming on the Hill might be impacting how Bitcoin is moving. So we saw in January, a little bit after Trump's inauguration, that Bitcoin rallied again to a new all-time high. Then again, for the meme coin dinner for official Trump back in the spring, we saw that Bitcoin again smashed another price record, reached a new all-time high. And it seems like there's a lot of moving in step between Bitcoin and what the administration does. The administration announces something, or lawmakers, talk about the asset or show they're embracing crypto, and then Bitcoin rises on the news. We've seen a little bit less of that though in the past couple of months, and it seems like we have all this good news coming out of the Hill, coming out of the SEC, the CFTC, but Bitcoin's not moving as much anymore. So I'm just kind of wondering what's going on here in your guys' view, right? Like, is the administration, are the regulators impacting Bitcoin's price? Is that something we should also be looking at and thinking about in terms of the 4-year cycle and whether it's still applicable to Bitcoin or not? Or is it something that, maybe it has some influence at first and now it's kind of waning in terms of its power and how much it matters to Bitcoin's price action?
Sure. I think for Bitcoin specifically, it's very much a macro asset with clear regulatory certainty. We know it's a commodity asset, and that's been spelled out by the SEC. It's not likely the case that the administration is having an impact on Bitcoin's price. It's actually more likely the case that liquidity is what matters, right? We were at an all-time high with Bitcoin not that long ago. It was early October. What also happened in early October? The government shut down, right? What happened then? Liquidity got worse, right? A big segment of our economy was not receiving a paycheck, right? That's a difficult situation for them, and also it just hurt market liquidity in general. So I think more than anything right now, hedge fund traders are watching not what happens on the Hill with Clarity, which matters for Solana and Ethereum. And we think about that a lot at ReserveOne, but they're watching what the Fed is doing right now with their program to buy T-bills, right, and to inject liquidity into the most kind of crucial part of the market, specifically the T-bills.
Yeah, I think there was a one-time effect of the Trump administration on Bitcoin. The effect was simple, which is, if you asked institutional investors in previous years why they weren't investing in Bitcoin, the number one reason wasn't volatility or valuation. It was actually regulatory concerns. We did a survey every year, and that came back loud and clear. And I think one effect that the new administration, new regulatory environment did for Bitcoin was clear the air. They made it a safe asset for institutionals to invest in. And I think that was helpful. I agree that now there's not much more that they can marginally do for Bitcoin. It's in sort of the regulatory clear, and the bigger effect is downstream on other crypto assets. I do think people are looking at the macro conditions, and that will set the term for whether that's a major driver or not next year. I'm not sure, but I do think that matters more than any incremental regulatory efforts specific to Bitcoin.
Now, you guys make great points, but just to kind of beat the horse a little bit more.
Yeah.
What about when Trump, for instance, said something like, the Fed earlier this month cut rates about a quarter basis point, and then Trump said they should have cut rates more, right? They should have cut rates at double how much they did. Does that affect Bitcoin?
Well, I mean, my general view is that people overestimate the impact of interest rates cuts right now on the crypto environment. The reason is, in the past, we were living in this world of extreme yo-yo swings on interest rates. We had interest rates crash to zero, and then the fastest hiking period ever, and then crash back down, and then right back up. Now we're talking about marginal 25, 50 basis point changes. I don't think they're as important as they were in the past. It certainly matters. It matters who the new Fed chair is, right? There are sort of two leaders in prediction markets. They have different views on the role of the Fed. That will definitely have a short-term impact. It matters incrementally what decisions they make from a rate cutting perspective, but I don't think it matters as much as it did in the previous cycles. I don't think it matters as much as it did in 2018, in 2022, because the scale of marginal cuts or increases that we're talking about is so much smaller. It's a contained set.
I think that the rate question will matter a lot for crypto next year, and for Bitcoin specifically. I concur with Matt that the regulatory changes, specifically potentially Clarity passing, could matter a lot for Solana and Ethereum. But with Bitcoin specifically, I think it comes down to what does the Fed do with rates and how do they think about this economy, right? And this is an economy of haves and have-nots if you think about growth, right? We have real CapEx growth in anything related to AI, and outside of that in the U.S. economy, it does not look great. The jobs don't look great either, right? So you have a Fed that's about to go through a transition in terms of leadership, whether it's Warsh or Hassett. Those are the two that are neck and neck on Polymarket right now. So people will care a lot about where the next Fed chair takes rates for Bitcoin, because it will matter quite a bit for Bitcoin, and the direction of travel here is potentially quite supportive for the economy, because if you strip away this success and potentially bubble-like behavior in LLMs and that sort of world, the core economy is not doing that well. And if the government is concerned about that, then it's likely the case that the next Fed chair moves a little bit bigger and more bolder. But the market's not going to move on what the president says. The market's going to move on what the FOMC does.
Let me just add one nuance to that. I more or less agree. Yeah. I think the bigger difference is what those two chairs would do from a QE and monetary perspective, as opposed to the interest rate side of it, because I think they're relatively aligned on lower rates, and therefore it may be more priced in. I think they have different views on the broader role of the Fed from a liquidity perspective, and I think that's where the marginal difference will be. And then the other piece of that is what will Treasury do if we hit a difficult economic perspective, right? Are we going to get things like stimulus checks or other forms of monetary easing? I think that mix will be the nuance that influences where crypto goes next year.
On this topic, I think we should really pay attention to the run-up into the midterms, right? The midterms are going to matter for crypto, Like, we know it's going to matter. Crypto was very impactful in the midterms before, in the election before, rather. And so crypto was a big issue, at least for candidates who were running. The question is how will that focus on the midterms consolidate focus on getting clarity done in DC, right? Our expectation of ReserveOne is that will happen. Everybody actually wants to get clarity done, maybe for different reasons, right? The Democrats want better safeguards in DeFi. Republicans think that it's well overdue to get this thing done. In either case, now it might be a bipartisan issue, and that could be quite constructive. But I think, again, we've got to focus on the run-up to the midterms, and really March and April, that's when most progress stops. So we've got to get clarity done before that.
Yeah, I think clarity is like the Puxatawny Phil of crypto of this winter. I think if clarity doesn't pass, it's going to push us into a deeper, it's going to be hard for crypto to rally. I think if you do see it pass, that's probably something like the all clear signal on this pullback, and we could see, I think, most assets, and particularly ETH and Solana and others, move to all-time highs.
Right, and there were reports that there's going to be no markup on market structure bill by the end of the year. So I mean, now it's like we're looking into next year to really see how lawmakers are going to deal with this issue on the Hill. Now, I want to wrap up this discussion by kind of talking about what has changed with Bitcoin in the past 5 years or so, right? Like, imagine you're pitching Bitcoin to investors in a room, which you guys pretty much do for your jobs in one way or another. I'm wondering, what are you saying to investors now, and what were you saying 5 years ago? Like, how did those conversations change? And is the 4-year cycle even a part of these discussions at this point? Or is this the whole discussion so evolved that it just doesn't even really factor in anymore?
I think with Bitcoin, for institutions, they're going to be less focused on whether a 4-year cycle exists or not, right? The way that they forecast returns is more like over a very, very long period of time, on the order of 30 years, right? And they have to come to a set of beliefs around returns, resistant to inflation, and a 4-year cycle, even if it exists for them, is less relevant. And it could actually even be an opportunity, right? They may say, okay, great, like to Matt's point, it takes 8 meetings and they meet every quarter. So it might take 8 quarters. And they might look at they might look at the 4-year cycle and say, well, shoot, that just creates an opportunity for us. And they don't have to believe in it to buy or not buy. They have to believe in the asset. In terms of how the asset has changed over the last 5 years, I mean, it's night and day. It's apples and orangutans. Nothing could be more different. Because 5 years ago, Bitcoin was it was a legally gray area, right? We didn't know if it was commodity or security. There were very few regulated ways to actually have exposure to it. All of that has changed in a massive way. We have qualified custodians. We have ETFs that are regulated by the SEC, including those of IBIT, or those of Bitwise, I should say. So the world has changed dramatically for Bitcoin. It's a different asset than it was in many cases for most institutional investors.
Yeah, I absolutely agree. The questions we answered from institutional investors 5 years ago were like, how does Bitcoin work? What is mining? How do you do custody? It was sort of fundamental questions exploring and understanding this asset class. When we go meet with sovereign wealth funds or pensions or even financial advisors, it's now questions about where it fits in a portfolio. It's what are the long-term return characteristics? What are the long-term volatility characteristics? What are the outlook on correlations? How does it behave in different market environments? It's an implementation question instead of an explanation question, and I think that's been a big shift. The other shift, which we didn't really talk about, is concern about debasement, and sort of debasement hedging has become a big thing in institutional portfolios. You have Harvard owning Bitcoin and gold. 5 years ago, that was a very edge case discussion. It wasn't really something people were worried about or implementing in their portfolio, and so I think that has shifted as well.